Unit 3. Basics of Bookkeeping, Bookkeeping Rules. Bookkeeping is the most important part of accountancy. It is orientated in the past, and only records business events. Bookkeeping is a business function, the task of which is to track business changes in business operations that reflect the assets, liabilities, capital, revenues, and costs of each business entity. Recording of business changes is based on business documentation, that is a set of documents that follow a certain business change, input, output, to determine how certain changes have occurred. The aforementioned documents contain all the information that is required for a bookkeeper to work successfully and monitor the business changes. Bookkeeping is a demanding task that does not suffer superficiality and improvisation. After going through this unit, you will understand the basics of bookkeeping and bookkeeping rules. Realize the differences between accountancy and bookkeeping. Know the basic concepts of an account plan. Bookkeeping is part of accountancy in which records of business events are recorded in business books using the dual bookkeeping method. In double-entry bookkeeping, business changes are reported that lead to an increase or decrease in assets, liabilities or capital. It is important to note that a business change has to be recorded and must have a certain value. The principle of double-entry bookkeeping is based on the fact that any business change at the same time leads to an increase in an asset item while simultaneously reducing another asset, liability item or capital. Accountants must understand financial reporting, many regulations, in particular income tax rules, value-added tax, accounting standards, and be able to present all types of accounting information to managers, present financial statements and offer alternative solutions that would improve and optimize business operations. Accounting can be defined as the most important source of information about a company, that is a comprehensive system of records in which plans, records, controls and analyses of the assets and operations of the company can be performed, and on that basis the accounting and financial statements are compiled. Accounting is the skill of recording, classifying and shortening the presentation in the cash units of expressed business transactions, and of interpreting the results. Accounting is a service function that collects, processes and presents accounting information about business operations and interesting users. Bookkeeping is the daily entry of business changes into the accounting system, that is the recording and classification of routine transactions, in accordance with legislation and regulations. Account plan. The account plan appeared in accountancy for the first time at the end of the 19th century, while its more significant application began in the 1950s. The account plan is an instrument by which the main book items are sorted in such a way that a user can check easily and in an organized manner what is recorded in the business owner's main book. This is achieved in such a way that each group of items in the balance sheet carries its own broader range according to the previously established accounting plan. The way entrepreneurs draw up an account plan is different in some countries. Hence, the obligation to apply an account plan may be regulated in the sense that it is recommended to apply an account plan. Elaborating on the content of an account plan of an entrepreneur, the state establishes an accounting framework. The state prescribes the content of the account plan for which the required obligations have been prescribed. In Slovenia, legal persons and sole proprietors are obliged to keep their books of account and compile annual reports pursuant to the provisions of the Accounting Act in Slovenia and other regulations, the Code of Accounting Principles, and the Slovene Accounting Standards, SAS. II. Account schedule in accounting plan. The principles that form the basis of the classifications of an account plan, as well as their positions in the balance sheet, the profit and losses of the account, and other financial statements. The basic classification positions are assets, capital, principal, and liabilities, obligations, expenses, income, the result of the current period. The allocation of accounts in the chart of accounts is based on the functional or balanced principle or on the connection of both. Slovenian chart of accounts and plans are based on process-based accounting. The frame of reference and the chart of accounts must be considered in terms of their breadth and depth. Their width usually involves the use of 10 chart classes, which are marked from 0 to 9. Balancing principle. The characteristic of this principle is the account plan in which positions are classified in the balance sheet and in the income statement. This means that the accounts of the assets are entered first and then the liabilities, followed by the expenses of the accounts, and then income and operating results. The combined principle, applying this principle to the accounts, is divided by a combination of the function and balance principles. II. Accounting principles. International Accounting Standards, IAS 1 sets out overall requirements for the presentation of financial statements, guidelines for their structure and minimum requirements for their content. It requires an entity to present a complete set of financial statements at least annually, with comparative amounts for the preceding year, including comparative amounts in the notes. A complete set of financial statements, based also on Slovenian accounting standards, comprises a statement of financial position as at the end of the period, a statement of profit and loss and other comprehensive income for the period. Other comprehensive income is represented by those items of income and expenses that are not recognized in profit or loss in accordance with International Financial Reporting Standards, IFRS standards. IAS 1 allows an entity to present a single combined statement of profit and loss and other comprehensive income or two separate statements. A statement of changes in equity for the period. A statement of cash flows for the period. Notes, comprising a summary of significant accounting policies and other explanatory information, and a statement of financial position as at the beginning of the preceding comparative period when an entity applies an accounting policy retrospectively or makes a retrospective restatement of items in its financial statements, or when it reclassifies items in its financial statements. An entity the financial statements of which comply with IFRS standards must make an explicit and unreserved statement of such compliance in the notes. An entity must not describe financial statements as complying with IFRS standards unless they comply with all the requirements of the standards. The application of IFRS standards, with additional disclosure when necessary, is presumed to result in financial statements that achieve a fair presentation. IAS 1 also deals with going concern issues, offsetting and changes in presentation or classification. IV. Accounting based on legal and professional standards. The organization of accounting in business entities is a complex process and depends on a number of factors that can be internal or external. Internal factors are different in each business subject and depend on the business involved, the size of entrepreneurs, management, etc. External factors are accounting regulations, which include the Accounting Act, International Accounting Standards and International Financial Reporting Standards, and in Slovenia, Slovenian Accounting Standards, SAS. Slovenian Accounting Standards, SAS, are prescribed rules and principles on professional conduct in accounting. These are the fundamental rules of financial accounting that determine when and how a particular event is recognized, measured and reported in the books and financial statements. Users of financial statements, such as tax authorities, banks, business partners, suppliers and buyers, or generally investors, are quite dependent on accounting standards, since they allow organizations to disclose relevant and accurate information in the accounts. Without the standards, the financial statements would be unreliable and incomparable. Slovenian accounting standards are compiled and issued by the Slovenian Institute of Auditors, which is authorized by the state for regulating and supervising the accounting profession in the Republic of Slovenia. The Slovenian accounting standards were updated in 2015 and entered into force on the 1st of January 2016. That is why they are known as SRS 2016. This is the latest version of Slovenian accounting standards. The previous version dated from 2006. Slovenian accounting standards are in line with International Financial Reporting Standards, IFRS. The entire Slovenian accounting standards comprise: Introduction to SAS. The SAS framework. Individual SAS. Individual standards are divided into three basic groups. Standards I, standards governing economic categories. Standards II, standards for external financial reporting. Standards II, specificity standards for organizations in individual activities. Slovenian accounting standards, SAS, are presented in the following list. In the list below, you can check numbers and names of International Financial Reporting Standards, IFRS. Finally, please take a look also at the list of numbers and names of International Accounting Standards, IAS. Both the Slovenian and European regulations of a company size are divided by size into micro, small, medium-sized and large companies. The definitions mainly focus on the number of employees and the annual balance sheet. The criteria for the classification of companies are determined by Article 55 of the Companies Act, ZGD. Entrepreneurs are divided into micro, small, medium-sized and large, depending on the indicators established on the last business day of the previous business year for which the financial statements are prepared. Indicators that represent the basis for determining which business falls into which category are divided as such: average number of employees during the business year, the amount of revenue, the amount of total assets. Article 55 of the Companies Act also defines the possibility of moving companies between categories or classifications. This happens if, on the basis of the data for the last 2 consecutive business years, the companies exceed or cease to exceed the criteria set at the balance sheet date of the balance sheet. Micro-enterprises are those who do not exceed the boundary indicators in 2 of the following 3 conditions. The average number of employees in the financial year does not exceed 10. Net sales revenues do not exceed €700,000. The value of assets does not exceed €350,000. Small enterprises are those which are not micro-enterprises, and do not exceed the boundary indicators in 2 of the following 3 conditions. The average number of employees in the financial year does not exceed 50. Net sales revenues do not exceed €8 million. The value of assets does not exceed €4 million. Medium-sized enterprises are those which are neither micro nor small companies, and do not cross the boundary indicators in 2 of the following 3 conditions. The average number of employees in the financial year does not exceed 250. Net sales revenues do not exceed €40 million. The value of assets does not exceed €20 million. A large company is a company that is not a micro, small or medium-sized company under the aforementioned criteria. In any case, among the large companies in Slovenia, there are public interest entities, a stock exchange and companies that need to prepare a consolidated annual report, banks, savings banks, housing savings, electronic money institutions, insurance companies, reinsurance companies, leasing companies, UCITS fund management companies, alternative investment fund management companies, UCITS funds, alternative investment funds, etc. However, Slovenia does not apply exactly the same criteria as the European Union. Therefore, before applying for a tender, you must make sure that your company falls into the appropriate category according to the criteria of the tenderer. Accounting concepts differ, therefore it is important to define the exact moment when the measurement and recognition of elements of financial statements have been carried out, whether this should be at the time that the cash flow was created, or at the time of the business event. The accounting concept also points to the basis of measurement of the elements of the financial statements, that is whether the total economic resources, financial resources, only the current part of the financial resources, or the cash flow and the balance are measured. In the aforementioned scenario, 2 fundamentals of accounting concepts are distinguished: the cash concept, the cash principle, and the concept of the event, also known as the accounting concept.